Corporate distributions. This is something we will definitely deal with much more in depth later on in other lessons. You can think of these like buckets, and that also I will dive into much more in depth later. So we've got many classifications of how distributions can be taxed. First off, you can see money being taxed as a dividend. And that's the most common one. You think, well, isn't everything a taxable dividend if a corporation distributes it? Yes, but no. Well, I'd say more no, because we'll talk about these rules. So when a corporation has money, such as current and accumulated earnings and profits, retained earnings, right? This is just the tax form of those words. When a corporation has that out of just their big old money pot, essentially they have available money to distribute. This is going to be considered taxable dividends. Shareholders have to include these dividends in their taxable income. Now we see here non-taxable return of capital. If a distribution is made and they don't have any money in the pot here, this is a big old pot and there's a lot of money in it. Current meaning the earnings and profits from this year, accumulated being earnings and profits from prior years. If there's no money in the pot, then these distributions, there still can be money or property distributed to shareholders. These are going to be considered non-taxable returns of capital to the extent of the shareholders' basis in the stock. And it's going to reduce the shareholders' basis, but it's not subject to taxation. It's also because this is not going to be the earnings and profits. This is essentially taking chunks out of the corporation, out of the property they have, and giving it to the shareholders. Capital gain distributions. Now, if the shareholder, and we will go through this is a slow introduction to this. We've got many slides, many lessons, or not many lessons. We got many slides in the future lessons going over this. So this is just a nice overview of what we'll see. You've got capital gain distributions. If there's no money left in the pot and the stockholder does not have any basis left, meaning they originally contributed $10,000 to the company and that money's been returned to them as a non-taxable return of capital, any money in excess of this is going to be considered a capital gain and taxed as a capital gain for the shareholder. So this is something we'll see. Again, like I said, we will see this. This is very important, but we'll see this in future lessons. This is just a nice introduction to it. For the order of distribution, how do we distribute money? Well, generally, we've got, let's say we declare $100,000 of distributions. We're going to take from the current earnings and profits. Maybe there's $20,000 of earnings and profits from the current year. Then accumulated earnings and profits. Maybe there's $80,000 of accumulated. So that would be it. That would be all the money. We distributed everything. Any excess is treated as non-taxable return of capital to the extent of the stockholder stock basis. You might be asking me, hey, how can you distribute anything if there's no money left in the pot? Well, you could distribute property that the company owns, such as land or assets, stocks, or you could take out a loan, and that would be a distribution. Different ways, not to get into that too much. Now, earnings and profits, this is the undistributed earnings that can be used to pay dividends. We've got two, which is current earnings and profits. This is going to be from the current year. And accumulated is going to be from prior years. It's going to be applied in chronological order, taking into account the corporation's earnings from previous years. Not too wild there. Now, stock dividends, we could also have, instead of property, like cash, right? We could have stock dividends. These are non-taxable to shareholders unless they have a choice between receiving stock and or cash or other property. And what would a stock dividend be? It's instead of someone saying, here's an extra $10,000 for distribution, here's extra stock in the company to reward you for being a shareholder, because that's the whole point of a distribution, right? Is to give shareholders something. You want to see a gain, and the stock price can't always go up. So distributions through dividends are a great way to reward shareholders. Now, property dividends. When a corporation pays dividends in the form of property, this is anything other than cash or its own stock. Again, this could be a building, give them a car, whatever. The dividends are taxable to the corporation paying them. The corporation is going to recognize a gain or loss as if it sold the property at its fair market value, which could result in a tax liability. We'll see examples of this numerically in future lessons as well. Now, as I said, kind of think about it like filling up the buckets. We've got current accumulated earnings and profits. This is going to be, and I'll draw it out, right? So think of it like you have a big spigot, right, of water, and the water is going to flow into a bucket. So first, it flows into the bucket of current earnings and profits. Then if it uses all of that up, it flows into the next bucket. This is accumulated earnings and profits. Then if there's too much water, and the water is the distribution, it fills up the bucket, and that is going to be all of the shareholders' basis. And then this is kind of like an infinite bucket, because anything after that is going to be capital gains. So that's what I mean by buckets, and there's your nice, beautiful illustration. I know no one out there can make an illustration better than I just did, and I know you can try, do your best, but this is perfect. It's flawless. The extent of stock basis are considered return of capital. So the treatments here is going to be dividend, return of capital, and then anything after that is capital gain. Keep in mind that distributions cannot be classified as capital losses. That's just not a thing. You're getting money. Yeah, you're getting property. You're getting something. So we're not going to see capital losses here. All right, we're going to see some numerical examples here. I know, I keep saying, oh, you'll see this later on, and then I show it to you anyway. Well, I just want to show you more examples. I mean, especially the topics that are incredibly important. Why not? Why not give you more examples? I mean, it sucks to do it by yourself. Am I right? It's not fun to just answer multiple choice questions in Sims by yourself. So if we can do them together, that's what we're here for. I'm also spent many years tutoring for the CPA exam, so I just do enjoy walking through examples with people. And while you're not here to respond to me, I'm just picturing your bright smiling faces here responding and learning a lot. So we first off have taxable dividends. ABC Corp has $100,000 in current earnings and profits, meaning this was their income for the year, and they decided to pay a cash dividend of $50,000 to the shareholders. This dividend is considered taxable, and the shareholders are going to have to include it in their taxable income. Pretty straightforward. Non-taxable return of capital. So in this case, this company has no current or accumulated E&P. They must have either made nothing, they have losses, or they distributed everything already. But they're going to distribute $20,000 to its shareholders. And again, where does that money come from? Don't worry about it. I mean, it's probably from a loan. They could just have cash sitting there. This distribution is going to be considered a non-taxable return of capital. It's going to reduce the shareholders' basis in the stock, but it's not subject to taxation. Now, GHI, they're going to distribute $30,000 to the shareholders, but they only have $20,000 in EMP, and the stockholders' basis is $5,000. So what's going to happen is we have an excess amount of $5,000. Because we're distributing 30, we have only 20,000 EMP. So 30 minus 20 gives us 10. Then we have a stockholders' basis. So we're going to say we have 10,000 we need to, so 20,000 was dividends. 10,000 minus 5, this is 5,000 return of capital, so that's gone. So then we have 5,000 left, and that's 5,000 that would go on forever. There's nothing after that. This is going to be treated as a taxable capital gain for the shareholder. And why is it a capital gain? Well, because ordinary income's at a higher tax rate. Capital gain, it's like the IRS saying, hey, yeah, I know, you're getting free money essentially at this point. We're not going to slam you with ordinary income rates. Now, the distribution order, the JKL's got $40,000 in current E&P and $20,000 in accumulated E&P. This is where if you saw a question where it really got into the nitty-gritty of it, this is what you would have to look for. It distributes $50,000 to the shareholders. Now, the first $40,000 comes from the current E&P once we use that up. Then the remaining $10,000 from this 50 comes from the accumulated. So there we go. And that's the order. Question might ask, what's left in accumulated earnings and profits after this, or what's left in current? Now, you have to look to the order of distribution. All right, more examples. You got to love them. We are going through and learning a lot. MNO Corporation, we've got $60,000 in current E&P for the current tax year and $30,000 in accumulated from previous years. Now, these amounts are going to represent the corporation's undistributed earnings that can be used to pay dividends. Sounds good. Stock dividends, we talked about those a little bit. PQR Corp, they offer the shareholders, stockholders, I was trying to say both words at the same time, a choice between receiving a cash dividend or additional shares of stock. If a shareholder does choose to receive stock instead of cash, this dividend is going to be considered taxable. We talked about this rule about how if they're given a choice, that changes things. Lastly, here we got property dividends. We got STU Corp. They decided to distribute a piece of real estate to shareholders as a dividend. Now, the real estate has a fair market value of $200,000 and a cost basis of $150,000. STU Corp recognizes a taxable gain of $50,000, and the shareholders are going to have to include this fair market value of the property in their taxable income. Looking good. Lots of great examples. Make sure you practice and studying up. Write down the ones you think you might have to practice additionally, or just come back, review it, spend time with me here in the lessons. It's a great time here. Few more slides and we'll be done. Couple other items. We've got worthless stock. If a C corporation stock becomes completely worthless, they go bankrupt, the courts decide that the stock's worthless, there's fraud, many reasons that it could become worthless. And the question would kind of have to tell you, shareholders can claim a capital loss equal to their basis. They lost their investment, right? In the stock. The loss is treated as if the stock was sold on the last day of the year. So that is dealing with, is it long-term, short-term? What is Section 1244? Well, this is something you should definitely know. This tax provision is going to allow original owners of certain small business corporations to treat losses on the sale or exchange of stock as ordinary losses rather than capital losses. And that's good because capital losses, we know, are capped at the $3,000 amount per year, net of capital gains or anything like that. The maximum ordinary loss that can be claimed is $50,000 per year, $100,000 for married filing jointly, and any excess losses can be used as capital losses, subject to the usual capital loss limitations, which can be $3,000. Now, to be eligible for Section 1244 treatment, the stock must be issued for cash or property in exchange for the first $1 million of the corporation's capital stock. So you see, kind of dealing with small business stuff here. Qualified small business stock. Now, this is a special category of stock that is going to offer tax benefits to individual investors. In order to qualify, the stock must be issued by a C corporation that meets specific criteria, such as having gross assets of $50 million or less. If an individual holds qualified small business stock for more than 5 years, they can generally exclude 100% of the gain from the sale or exchange of the stock up to the greater of, and in this case, 10 times the taxpayer's basis in the stock, or $10 million. We are powering through. We got a few more things here. One more slide after this. We got our liquidating dividends. What is a liquidating dividend? We'll see this very much as we get more toward our latter corporation lessons, where we deal with the termination of a corporation. Now, when a C Corp is in the process of liquidation and distributes its assets to the shareholders, the transaction is considered a liquidating dividend, so we're closing up shop. We are getting rid of all of our business. The corporation is treated as if it sold the assets, and any gain is equal to the fair market value minus the asset's basis. This gain is going to be subject to corporate level taxation. Now, shareholders receiving the assets are also taxed on the difference between their basis in the corporation stock and the fair market value of the assets they receive, which can result in double taxation, but we knew that getting into business with a C Corp to begin with. That's just how it works. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.